Welcome to Factful Finance. Let's dive right in. What happens if you lose your job and your mortgage still needs to be paid? Unemployment can throw a wrench into your financial plans, but there's a lifeline: unemployment insurance, UI. But how exactly does UI help with mortgage payments? That's what we'll unpack today. Stay with me as we explore how UI can provide financial relief during tough times and how it might help you avoid losing your home when life throws an unexpected curveball. Before we dive in, a quick note. This video is for educational purposes only. Listings of apps or products don't an endorsement, and it's always a good idea to consult a professional for personalized advice. Now, let's get into it. When you lose your job, the most immediate concern is covering your basic living expenses, including your mortgage. This is where unemployment insurance comes in. UI provides a temporary safety net, replacing a portion of your income while you search for new work. It's a state-run program, meaning each state may have slightly different rules, but they all work on the same principle: to support you during a financial transition. But how does it actually help with your mortgage? Think of your mortgage as a fixed expense, something you can't simply walk away from, even in tough times. If you're receiving unemployment benefits, those payments can act as a partial replacement for your lost income. While UI typically replaces only a portion of your earnings, often between 40% and 50%, this money can still make a significant dent in your monthly mortgage payment. Take, for example, Mia. She was laid off from her job as a graphic designer and had a mortgage of $2,000 per month. With her UI benefits, she received $1,200 a month. While that didn't cover the entire mortgage, it certainly helped alleviate some of the stress, allowing her to stay current on her payments while she looked for a new job. Of course, the amount you receive through UI depends on your previous earnings and the unemployment rate in your state. Some states offer additional benefits during times of economic crisis or high unemployment, which could further assist in covering your mortgage and other essential expenses. However, UI is not a long-term solution. Typically, benefits last between 12 and 26 weeks, depending on the state and economic conditions. This means that while it can help in the short term, you'll need to make plans for the future. But here's something important to remember. In some cases, mortgage companies might offer forbearance during times of economic hardship, allowing you to delay or reduce your payments temporarily. Now let's take a look at how this works in action. Imagine Elijah, who lost his job as a sales manager. His state provides a maximum benefit of $450 per week. With his $2,500 monthly mortgage, UI doesn't cover the full payment, but it certainly lessens the load. If Elijah and his mortgage lender agree on forbearance, he could delay payments or even reduce the amount owed until he finds stable employment again. For those of you thinking about whether UI could help prevent foreclosure, the answer is, it depends. UI is meant to be a temporary solution, but if you find yourself unable to make full payments in the long term, it's crucial to communicate with your mortgage lender. Many lenders will work with you to modify the loan, which can result in lower monthly payments or even reduced interest rates. Now, some of you might be wondering about other resources to consider. There are programs like the Home Affordable Modification Program that were designed specifically to help homeowners during the 2008 financial crisis. While these programs aren't always available, they are worth checking out as you explore all your options. Before we wrap up, let's take a look at how UI affects your mortgage in a broader sense. Studies have shown that during periods of high unemployment, home foreclosure rates tend to rise. By providing a temporary income, UI helps reduce the likelihood that individuals will default on their loans, thus lowering the number of foreclosures in the market. In fact, the National Bureau of Economic Research found that for every 10% increase in UI benefits, the likelihood of foreclosure decreases by 2 to 3%. This is critical because it gives people a chance to get back on their feet without the looming fear of losing their home. But remember, UI is just one part of the equation. To truly protect your home, you need a comprehensive strategy, working with your lender, exploring forbearance options, and planning your finances in case your unemployment stretches longer than expected. So, what's the first step you'll take towards securing your financial future during tough times like unemployment? Let us know in the comments. Thanks for joining me today on Factful Finance. If you found this helpful, why not hit that subscribe button so you don't miss out on our latest insights that can help you reach your financial goals. We think you'll enjoy the video shown next, which may give you more tools and tips for managing your finances in uncertain times. See you in the next video.